pikespeaksbdc.org.
Well, welcome back, everyone. So we're at the Pikes Peak SBDC Cyber Summit. This is our annual summit where we get to talk about topics related to small business and help you recognize those risks. And that's what this discussion will be, is on risk management. So we're going to look at risk management. At the end of the day, we deal with risk in our daily lives. When we get in our vehicle and we leave our house and we drive to work, there's an element of risk associated with that, right? We've got traffic to deal with. Do I have enough gas to get to work? Am I late? Am I going to introduce additional risk because, I might be late or, there's risk associated with our business as well. And risk is one of those areas that we understand based on a perception of risk that we have on our day-to-day activities. I know if I don't pay for my goods and services to come in and I operate a restaurant, I'm not going to have the inventory that I need to keep my doors open. All right? What is the risk associated with our business? Well, there's various terms that we use associated with how we perceive risk, how we manage risk. We assess risk on our own, sometimes within our own mind, but there's a lot of elements that come together that converge into our ability to understand risk within our organization, understand how to manage that risk, and how to understand and assess that risk based on our perceptions of risk. So one of the things that Jonah talked about from the National Cybersecurity Center this morning was governance. Well, when we use the term GRC, Governance, Risk, Compliance, these are three ideas that come together and create an industry for very large, complex organizations. A GRC strategy, a Governance, Risk, Compliance strategy, have elements that relate to each other that allow an organization to better understand what industry it's in, what laws, regulations, what does it have to comply with, compliance, which we're going to talk about later, and what is the risk associated with the activities in meeting those requirements. All right, so we're going to talk about risk. All right, risk, let's talk about what is risk, right? It's the probability that a threat agent or a cause will exploit a system vulnerability or weakness and thereby create an effect that could be detrimental to the system. What system? It could be your point of sales system. It could be your mobile device. It could be your work computer. It could be your home computer if you're doing stuff from home. All right, risk. Risk management, all right, this is a perspective of how we deal with it, right? Is the identification, assessment, and prioritization of risks, which followed by a coordinated and economical application of resources to minimize, monitor, and control the probability and or impact of unfortunate events. But not all risk is negative, or maximize the realization of opportunities. So risk management. Oversight for risk management, or what we refer to as corporate governance, is a critical activity that should occur within an organization. So as was discussed earlier this morning, we have governance. All right, we have external governance, the laws, the regulations, or those things that we have to comply with. And then we have corporate governance. Corporate governance is all of the documentation that we develop internally. Plans, policies, procedures, guidelines, those things that we write down that help us comply with external governance. So external governance, think of, it was talked about HIPAA. So if I'm in the healthcare industry, I may have to comply with EPHI, the Protection of Electronic Personal Healthcare Information. What if I take credit card payments? PCI DSS, Payment Card Industry Data Security Standard. That's not a law, but it's regulated by the credit card industry. So if I want to collect credit card payments, I have to comply with PCI DSS. FERPA, a unique law passed in 1974 by the federal government to protect the personal information associated with our children. All right, so if I'm Dana-Farber Hospital Institute in Boston, Massachusetts, and I am an academic hospital and I take credit card payments, I now have to understand that I have to comply with PCI DSS because I accept credit card payments. I'm a healthcare organization, so I have to comply with HIPAA. And, I have students in my organization, so I have to comply with FERPA. Compliance will be something that we talk about later, but if I understand what I have to comply with and I understand what my current capabilities are, I need to assess whether or not I have all the requirements in place to be able to meet all my regulatory requirements. Corporate governance, those plans, those policies, those procedures will help me better understand what I'm doing well, and where I may have gaps. The chief risk officer in a medium to large organization would be able to manage the risk for the organization, would provide advice, organizational leaders about risk to the business, and then make recommendations for treatment of those risks. As a small business, you may be the sole entity that's doing that in your organization. You have to understand what your compliance requirements are. You have to understand what methods are for your employees to be able to meet those requirements, and it should be repetitive, and there should be an ability for you to measure that capability. We don't want that one employee just to try and perceive what they have to do to comply with the requirements in your industry, especially if they don't have the same level of experience that you do. Business risk sources. Most of our risks come from either internally, based on lack of processes or procedures or an understanding of how to conduct business, or externally. Those things that are external to an environment, such as competitors or federal agencies, those things that could have an impact on the way that we conduct our business. So business risk sources are going to usually be categorized as internal or external. So here's some examples, all right? So think about it. Internal or external risk. Economic downturn. Can you control that? That's the question you have to ask yourself. Can you control the risk? It may be an internal risk if you can control it. If you can't control it, it's more likely going to be an external risk. So an economic downturn could be based on the federal government, global economy. That would be an external risk item that could impact you. If you take a look at what's happening with the pandemic right now, the cost of goods are going up. There's a lack of chips for computer devices in vehicles, right? So those all impact the economy in some way or another. Losing key employees. Unless all of your employees are at minimum wage and you provide a really poor work environment, an external entity that's a competitor may steal your employees away. But remember, losing key employees may be an internal issue because you're not paying well enough, or maybe it's a crappy environment. It's an internal issue. It's something that you can control. You can pay higher wages. You can make sure that you have a better work environment. You can provide benefits. Whatever the strategies are within your organization that allows you to better understand why you may be losing key employees. Something under your direct control. Quality of customer service. Again, I look at training. I look at awareness. I look at having conversations with my staff in key areas. I look at observing, assessing how my staff are interacting with people. So I would say that this is an internal risk area. So the quality of customer service is going to be based on something that I can control. Regulatory changes, now we're moving outside the organization again, right? So legislation gets passed, and those new laws need to be understood, and so I need to be able to adapt to those. So new regulatory changes may impose things that are undesirable on my business that I need to better understand and then be able to adapt to. So that would be an external risk. Lack of capital to meet growth. Again, based on the amount of income that's coming in, the amount of revenue, the amount of expenses, how much capital is left over to be able to invest in my business to be competitive in my industry. Lack of capital to meet growth, that's going to be something internally that I can control. In an economic downturn, there may be external forces that hinder my ability to have the capital to meet my growth. So there's a relationship there that may have a dual entity, but it's going to be internal in nature. Optimization of capacity. Am I doing the best with what I have to optimize my business capability? All right, so again, that's an internal risk item that I have a better understanding of. There might be some external influences. However, do I have the right people with the right skill set, with the right trade craft to be able to produce at the level that I expect to make my business successful? Optimization of capacity, being able to do the most with what I've got. All right, so the essentials of risk management. So there's a model here that comes directly out of the ISO standard 31000. Right, the enterprise risk management model. Enterprise means business in this context. It doesn't mean computing environment. So the enterprise risk management workflow is an accepted business risk management model that the CISO or the business owner can follow to manage the information security risks. So as a business owner, I can identify risk exposures. All right, what's a risk exposure to my business? Well, if I have a storefront and it's very close to a parking lot, and I don't have anything to prevent anybody from accidentally bumping into my building with their vehicle, that might be a risk exposure. Maybe I want to put some bollards or stanchions in front of my business. All right, reduce the risk associated with somebody accidentally bumping into my business with their vehicle. That's an example, right? So we want to be able to measure and estimate our exposures. All right, how likely is something to actually happen to my business? If it was to happen, what would be the impact? So if I decide to build a large business in Oklahoma City, what would be one of the natural disasters that I would be concerned with? Tornadoes. Oklahoma City is the #1 city in the entire country that has the most F2 tornadoes. F2 being a measurement of the size of the tornado. So if the likelihood of a tornado coming through and the impact, the damage caused by that tornado would be a risk exposure I would want to evaluate and then decide whether or not or where I wanted to build my business location. So those exposures are those things that could hinder our ability to be able to be productive and actually achieve success in our business. Exposures on the cyber side, look at those things that we've talked about throughout the day. Do I implement antivirus? Do I update the patches on my network and on my computer system? Do I provide cybersecurity awareness training to my employees? Remember, we've said that the #1 most significant threat is the human. Well, we need to train the human. We need to be able to provide awareness to the human to reduce the risk associated with them being a threat to our business, either intentionally as an insider or accidentally as an insider. All right, so once we measure, estimate those exposures, we're going to take a look at the assess or the effects of those exposures. Again, what's the impact if the risk was to be realized? All right, and then putting countermeasures to reduce that. It helps us determine a risk treatment strategy. Once I do the assessment of those exposures, do I want to accept the risk? All right, what's the likelihood that it's going to impact my business? Well, the more likely it is, I may want to avoid the risk altogether. Accept the risk, avoid the risk, eliminate the risk altogether. Maybe I want to share or transfer the risk. Maybe I don't have the skill set, the trade craft necessary to be able to manage the cyber hygiene for my organization. I do something particularly well. Maybe I hire a managed security service provider to manage those things for me that I don't know and understand. All right, transfer or share the risk. I still own the risk. I'm just hiring somebody else to manage it. One of the most prevalent methods for transfer or share is to buy an insurance policy. All right, so if I was to realize the risk and there was damage to the organization, I fall back on the policy to make reparations financially, fiduciary, to be able to bounce back. So mitigate or modify the risk. This is the number one most used. I'm implementing controls to reduce the risk to an acceptable level. Earlier this morning, you heard Jonah from the National Cybersecurity Center talk about controls associated with various frameworks. So PCI DSS has its own framework. NIST has its own framework. There's several different frameworks with ISO. Depending on your industry, you may want to consider adopting a framework that allows you to implement controls that allow you to reduce the risk with a certain thing that could disrupt your business, like change management. Do I allow changes to network devices? Well, can I afford to be down if somebody makes a change and doesn't coordinate? There's a mature method for implementing changes within my organization, so I minimize that disruption. Mitigate or modify is the most used because I'm looking at implementing a countermeasure or some type of control to reduce the risk to my organization. And then I want to evaluate, did I choose the risk treatment method? All right, maybe not. I need to go back, and if I'm not achieving the amount of risk management as expected, maybe I'm realizing a little bit more risk or cost or an interruption or disruption to my business, I want to go back and reevaluate and maybe come up with a different strategy. It's a continuous process. The essentials of risk management, again, ERM, Enterprise Risk Management, enterprise meaning business. Understand risk to your organization. Use an accepted process or a framework to measure the risk and the impact. Some of these may be mandatory to you. So if you're in banking and finance, the Greenleach-Bliley Act ties back to a privacy requirement on how you manage information or data associated with your clients. If you're banking and finance, you may have to comply with FDIC controls, banking requirements that may be evaluated by an external regulatory authority. You should have a strategy of evaluating those internally yourself prior to getting that external third-party assessment. That way you have a better understanding of what the compliance requirements are and then measuring your current status against having a third party come in to let you know that you've got significant challenges. Communicate identified risks to the right people within your organization. All right. Those that may have different business activities. Remember, 80% of our business processes are automated. And so if they're automated, we're using technology. And so I need to communicate risk to the right people in my organization so they can help manage, recognize where we may have exposures, and then help implement one of those risk treatment methods to be able to reduce that risk. Select an appropriate risk treatment plan. Remember, accept, retain, avoid or eliminate, transfer or share, mitigate or modify. Those are your risk treatment methods. All right? Choose one of those and then obtain executive buy-in or endorsement for your risk treatment plan. If you're a small business, you may be the sole authority on all that information that's being advised to you in order to make the right decision. All right, implement the approved risk treatment plan, including any respective controls. And remember, some of those controls could be based on a specific framework. If you're trying to figure out the controls on your own, some of the considerations are based on some frameworks that are readily available. Some frameworks, such as NIST, there's various frameworks through the National Institute for Standards and Technology that an organization can implement so you have a structured approach on how to manage risk for your organization. So implement the approved risk management program, measure the ability to comply with those controls, make sure that the exposure, the amount of risk is reduced to an acceptable level, and then communicate effectiveness of your risk treatment plan and your risk management program to other stakeholders, either business associates, consultants, clients, or internally within your own personnel. Discuss the opportunities for additional risk mitigation for residual risk and then new risks identified by the organization. Remember, residual risk is that amount of risk that exists after I implement my risk treatment strategy. I may not always be able to implement the preferred controls. I may not have enough time or resources or money to be able to apply the preferred method, but anything I can implement now to reduce that risk to an acceptable level, the leftover risk until I can get to where I'm very comfortable is referred to as residual risk. Enterprise risk management provides the historical perspective for defining a structured process to identify risks, propose that treatment, and then evaluate your performance of your risk treatment option selected. Information security risk management depends on the following key elements. I talked about risk. This comes directly out of the NIST Special Publication 800-39. So readily available as a PDF document on the internet. Assign risk management to senior leaders. Recognize information security risk to the organization. Remember, 80% of our processes are automated. Establish the organizational tolerance for risk, and then communicate that risk tolerance throughout the organization. And then accountability by senior leaders for their risk decisions or non-decision. Remember that non-decision is a form of acceptance, so you've, through silence, made a decision. All right, so how do we understand what risks we have, and how do I evaluate my performance? The number one method is to conduct a risk assessment. We can do this internally through our own resources. We can hire a third party to come in, or we may have a mandatory compliance requirement to be assessed by a third party depending on our industry. All right, so the business must understand the risks facing the organization before the business can identify and recommend an appropriate security strategy for addressing those risks as they relate to the enterprise. Remember, enterprise means business. All right, so this chart here indicates some of the things that we've already talked about. Before I do anything associated with risk, understand there's a term for that. It's called inherent risk. Inherent risk is all that risk that exists before I have an approach, before I do anything. All right, I have to perform a risk assessment to better understand where I'm lacking resources in a risk mitigation strategy and propose that treatment. So how often does an organization perform a risk assessment? Jonah covered a little bit of this morning in his presentation. Most often, a business is going to be performing a risk assessment always initially. I've stood up my business. I've implemented a bunch of systems and controls. It's probably going to be a pretty comprehensive assessment, right? So I'm going to assess everything initially. It's very comprehensive. Once I've started into business, I need a periodic assessment. So periodic could be 6 months, could be annually. Again, depending on my industry and what my risk tolerance is, I'm going to want to have a periodic assessment of my organization. And it may be only focused on those key critical areas of my business that are the ones that, if disrupted, would impact me most. It may not be everything, but just those key critical areas. It should always be after I implement a change. If a change could disrupt my business, my telecommunications, anything to that perspective, I need to understand that. I need to have a methodical approach to implementing change within my organization. And I'm not talking about changing employees. I'm talking about your automation, your computer systems, your patches, changing configurations on your firewall. Let's make sure that we're doing that through a methodical approach. And then always after incident response. If there is a disruption to my business, I want to make sure that I understand what happened, how it happened, understand the disruption, stop the disruption, get the business back into operations as soon as possible. And then I want to make sure that I implement controls to eliminate or prevent or minimize that threat from happening again. All right, so those are the 4 most often times I'm going to perform a risk assessment. Going back to what happens after the risk assessment, I know what the gaps are. I know what the risks are. I know where I'm not compliant with various controls. I implement a risk treatment strategy. Accept, retain, avoid, eliminate, transfer, share, mitigate, or modify. What's left over, we talked about, is residual risk. I'm going to carry that residual risk, not in my brain, but on a piece of paper or an electronic document and I'm going to rack and stack all my residual risks so that as I get more resources, more money, more time, or I get the technology, I'm going to go back to the risk register where I record the residual risk, and I'm going to address those things as I'm able to. If you look at the very far left of the two blue boxes, you see a parallel and a vertical line. All right, so the vertical line and the parallel line represent a couple of additional terms. One is referred to as risk tolerance. Risk tolerance is an individual perception of risk that I'm not going to exceed. It's the maximum amount of risk I'm willing to take in pursuit of my long-term goals. All right, I just don't have enough information to go further than that, or I've drawn the line in the sand. I'm not going to exceed risk tolerance. All right, risk appetite is the range from 0%, but no more than risk tolerance, that allows me to make decisions based on information that I have. The more information that I have, the more likely I am to expand my risk appetite, but no more than risk tolerance. Jail, no jail. You see on here that I've got these two terms. I have a relationship with my accountant. His job is to maximize my return to the utmost where it's not illegal, because I don't want to go to jail. Risk tolerance in this context is where I draw the line in the sand. I don't want to go to jail by making claims on my taxes that wouldn't stand up to the scrutiny of an audit. So my risk tolerance is, hey, maximize my tax return up to the point where I'm not going to jail. All right, so how often do we perform the risk assessment? Just recapturing this. Always initially, periodically, at least annually. All right, organizationally defined, unless your industry determines that it needs to happen more often. Always part of change management and always after incident response. Risk analysis or risk assessment approaches. Some of them can be qualitative, and as a small business, this is probably what you're going to do more often than a quantitative, which is ingesting a lot of information. All right, so risk assessment begins by selecting an approach to evaluate the risks facing the organization, either a qualitative or subjective approach, or a quantitative approach where I collect information and provide data that allows me to better understand and choose a risk treatment strategy. Again, a qualitative approach is also referred to as a subjective approach. Qualitative risk analysis focuses on mapping the perceived impact of a specific event occurring to a risk rating agreed upon by the organization or the business owner. So this one is going to be more appropriate for the small business owner. Most methodologies use interrelated elements such as threats, vulnerabilities, and controls, those things that we're familiar with in our business and within our industry. The benefits, I can make a fast determination. I don't need a lot of data, right? Flexibility to define risk ratings like low, moderate, and high, which are understood by most people, right? I'm not going to go outside in the middle of a snowstorm with a pair of shorts and flip-flops on. I know that that's probably high risk for hypothermia if I stay out there for too much period of time, right? We use these to make those types of determinations within our own business. I know that if I don't contact my customer back within a certain period of time, I might lose that customer, right? I don't need to collect data to understand that that is a risk to my organization. Probability data, precise formulas are not required to define that level of perceived risk. All right, quantitative. You may be in an industry that's highly regulated, like healthcare, like banking, like finance. All right, now you're talking about a quantitative assessment or a numerical assessment. This is a risk analysis which focuses on the mapping of probability of a specific event occurring to the perceived cost of the event. A very fundamental calculation. So the probability that an event will occur, and then the likely cost to my organization should that risk be realized. All right, so I look at the annualized rate of occurrence, ARO. I multiply that by the single loss expectancy, and that gives me the cost of my annualized loss expectancy. So let's go back to Oklahoma City. If I build a business in Oklahoma City and say The annualized rate of occurrence for F2 tornado is 5 times a year. And the impact, the single loss expectancy, the cost associated with one event happening is $10,000. What is my annualized loss expectancy? $50,000 impact to my business because 5 times annualized rate of occurrence multiplied by $10,000 for one single loss expectancy provides me, I need to purchase $50,000 worth of insurance to take care of my business. So a very simple perspective depending on those things that you can identify that might disrupt your business. A numerical assessment. So the benefits here are it provides a business owner opportunity to identify the impact for many risks and then to rank those risks in order of its annualized loss expectancy. Helps improve your decision process and helps you better manage your business. Some of the drawbacks associated with that is it does require a significant amount of data to support your formula, depending on what you're trying to measure. Remember that unreliable or inaccurate data affects the outcome. You may be planning for things that may not be applicable. And then probability data is rarely precise and in some cases promotes complacency. We can't plan for the 100-year storm. Risk perspectives. This is really where it comes down to, right? What are our feelings about risk? What are our perceptions about risk? How do feelings influence the way the organization evaluates risk? So the perspectives organizations have about information security risks influence the actions that they take to manage those risks. I apply this to the relationship I have with my teenage daughter. She wants to go out with her friends. I'm like, okay, where are you going? I don't know. When are you going to be home? I don't know. Who are you going with? I don't know. Oh, that's really easy. That's too much risk. So the answer is no. Right? So apply that to something that you know fairly well within your business. All right? The perspectives that you have influence the actions, the attitude. I don't have enough information to make an effective decision, so I may eliminate that risk altogether. As I gain more information, my appetite grows, and I may be able to choose a different risk treatment strategy. Different terms are used by different standards in organizations to define these perspectives. Risk tolerance, risk appetite, and risk aversions. These are perspectives that are associated with the feelings about potential outcome and the amount of risk the organization is willing to take to achieve its goals, whether they're short-term or long-term. So risk tolerance, going back to this, remember the red line? The maximum, right? Defines the level of risk the organization is willing to assume based on organizational perceptions of risk. It's the maximum. Marks the boundaries of risk-taking outside of which the organization is not prepared to venture in pursuit of its long-term objectives. It's too much risk. Tolerance is right here. I don't want to exceed my risk tolerance. Risk aversion. Go back to my relationship with my teenagers, right? The reluctance of a person to accept a bargain with an uncertain payoff. I don't have enough information to make an effective decision. It's too much risk. It's the amount of risk the organization is willing to seek in order to accept or pursue its long-term objectives. Risk aversion doesn't provide me enough information to feed into my risk appetite. Remember, risk appetite is the range from zero risk to no more than risk tolerance, right? So principles of risk appetite, it can be complex. It needs to be measurable. It's not a single or fixed concept. It can be complex. Again, depending on your industry, am I a highly regulated industry? That's where it can tend to be more complex because I need to be able to demonstrate capabilities that show that I'm compliant with certain things. It should be developed in the context of the organization's risk management capability. It must take into account differing views at a strategic, tactical, and operational. Strategic is you in the strategy of how you're going to manage your business. Tactical is the approach of how you're going to manage that risk. And then operational is the accepted approach that you've explained to the rest of your employees on a day-to-day functional operation of your business. All right, some industry-recognized risk credentials. Remember, you can come down to the Pikes Peak Small Business Development Center, the SBDC. It's a free resource in your community to be able to access people to help you manage risk within your business. If you're not going to use us as a resource, you need to consider others that you may hire or consider that need to be credentialed. See, these are some of the top credentials in our industry that understand how to manage business risk. ISO 27005, Risk Manager. All right, so this is for information security risk as it relates to those assets in your business that you use to manage your risk. ISO 31000, remember I talked about enterprise risk management? This is the holistic approach to manage all risk, financial risk, safety risk, information security risk. They all feed into your holistic approach for enterprise meaning business risk management. And then certified in risk and information systems control. CRISC is a professional credential issued by a certification body here in the United States. So I can tell you that all of our consultants here at the SBDC are credentialed in one of these or many other areas to help your business. So not only are we experienced in helping you identify and manage risk for your organization, but we'll help you with those strategies, and we're sound in not only our approach, but we're credentialed in these areas, experienced in these areas as well. Again, come down to the Pikes Peak SBDC, meet with a cyber consultant, or meet with any of our consultants to help you better manage your business.